one of the biggest debates in the stablecoin space right now is the potential of non-USD stablecoins. One side thinks USD stablecoins will far outperform non-USD stablecoins like the Euro or Swiss franc. The other side argues that USD stablecoins will lead the race, but they won't have a monopoly like today, especially when on-chain FX kicks in. What do you think, Romeo? Which side are you on? Do you think on-chain FX will be the unlock for non-USD stablecoins?
I think FX as a category is a huge opportunity for stablecoins. We have discussed unsecured lending last week. FX is an order of magnitude bigger than unsecured lending. The FX market right now is about 80 plus trillion dollars. About $8 trillion are moved in the FX market every single day. And this is actually data from 2022. I saw some up-to-date numbers that put the OTC derivatives notional figure at about $150 trillion with about like $10 trillion in daily settlement. So, this
And
is
it's
gigantic.
interesting that you mentioned those volume numbers. And when you compare the crypto market to the traditional FX market, crypto looks like a drop in the bucket.
Oh, I mean, yeah, definitely. So, I mean, yeah, exactly. So, even before we get into the whole USD versus non-USD stablecoin thing, we have to get stablecoins in the room first, and that's not an easy thing to do. So, like, I was recently reading a paper by Borja Neira about the state of on-chain FX and the problems that we need to solve first. He was talking about the fact that we fixate on the visible tip of the iceberg, which is retail spot trading, remittance
Right.
corridors and AMM pools, but the market is far, far bigger than that. So basically, the real game of global FX is not just like exchange of euros for dollars by tourists or the cross-border payments of flows of small to medium enterprises. It's institutional dollar funding market. Like it's a gigantic machinery built on FX swaps, forwards, and currency swaps. This is the domain where over $80 trillion of synthetic dollar debt resides, mostly off balance sheets, acting as basically you can think of it as the lifeblood of global banking and the primary transmission mechanism for any kind of financial systems today. So, and if you look at it from where I stand, like right now, the world runs on a fragile, invisible layer of funding called the FX swap market, which is what it is. Like the terrifying reality is like non-US banks, insurers, and pension funds. They are sitting on tens of trillions of dollars of obligations that they have to constantly roll over. And it's basically think of it as a massive game of musical chairs where trillions of dollars are on the line. And when the music stops, and the music stops, like, using the reference from the movie Margin Call, like when the music stops, like in 2008 or the COVID crash of 2020, the
Mm.
swap market freezes and the entire global economy goes into like I like to think of it as a cardiac arrest, and it even gets worse when you think of it like the big currencies like USD, Euro, JPY. They are protected by the CLS system. So, but there is a gaping hole in the market. Every single day, about $2.2 trillion in FX trades settle without the CLS system, like outside of the CLS system, without protection. That is textbook Hurst risk. This is the nightmare scenario when like if you send money to a bank and and the bank gets it but they don't release the currency that you want it to, then you have essentially lost your money. And so this is the risk that the CLS system avoids, but this risk is concentrated in emerging markets, exactly
But I
where
thought,
the
but I thought we
like
had systems like CLS to prevent exactly that. Like, if it exists, why is there still a 2.2 trillion gap that you just mentioned?
so basically the thing is CLS is only available to I think 16 or 18 currencies. The CLS umbrella doesn't cover every single financial currency in the world. It's only from the first world, the already established developed world currencies that gets to participate in the CLS system. Now obviously there if you are part of the correspondent banking chain, you can, even if you're not part of the CLS system directly, you can have your correspondent banks in other countries that they can help you with your monetary plumbing. But all that chain gets like really long when you go far back enough into the emerging markets, local banks, right? So that's where we need a system like the CLS system on chain where we can support these banks and protect the volumes that they are pulling. So basically the winning architecture for the next generation of FX infra uh, will not be built on like an open permissionless liquidity pools or retail stable coins with really opaque creditor hierarchies, etc., etc. It has to be like built on boring plumbing focused primitives, just like the CLS system that we were mentioning that needs to be opened up to get more people to get more currencies in. So there has to be have a few things that we need to put in place first. One is some sort of a smart contract implemented. ISDA. ISDA is International Swaps and Derivatives Association. So this is a master agreement that explicitly encodes notional, tenor, margining, and closeout logic. You need to have payment versus payment rails. The atomic settlement mechanisms has to like extend risk-free finality to non-CLS currencies, which is what exactly we are discussing. And also you will have to like allow tokenized commercial bank deposits and wholesale CBDCs that respect the Basel III capital constraints and credit limits of global dealer banks. Like that, these are pretty technical stuff, but when we are discussing for FX, FX is not really a fancy crypto things that will generate 100x on a meme coin or something like that.
I mean, the ultimate goal of this transformation is to make the $80 trillion debt visible, margined, netted, and programmable. Like you have to provide corporate treasurers and central banks supervisors with a real-time map of dollar obligations, replacing what they have currently, which is basically a fog of PDFs, bilateral spreadsheets, and delayed regulatory reporting. So to understand like why the FX like spot FX market is a distraction as a goal, you have to like really analyze the volume and the purpose of global currency transactions. Like the market is not primarily driven by trade in goods and services, but it's driven by management of balance sheets and funding of assets. That's how the market moves. So when you are looking at the spot market, I mean, look at the BIS 2020 triennial survey that they released. Like FX swaps was like accounted for approximately 51%, which is like $7.5 trillion in daily global turnover, significantly overshadowing the 28% share held by the spot market. So you have to first look at what's happening in the swap market, in the forward market, and then and to try to address those issues first, because that is the bigger opportunity.
Right.
Institutions use FX swaps to borrow dollars synthetically. Like for example, a Japanese, let's say, insurer holding yen, but they want to invest in US treasuries. They don't have to typically sell yen to buy dollars outright. You know
Right.
that creates an unhedged FX risk. So instead, what they do is they will enter into an FX swap. Like they will sell yen for dollars at the spot rate today, and simultaneously agree to buy yen back for dollars at a forward rate in the future. So effectively, they are collateralizing their yen to borrow dollars, and they are offsetting their FX risk essentially. So the systematic risk arises because these swap obligations are treated as derivatives, not debt, like under with the accounting standards that we have currently, and they are obviously then largely recorded off balance sheet. So this is what PIS describes as hidden debt, because standard external debt statistics, they don't work. Like those things track bonds and loans, but they miss these massive payment obligations. So if you don't know what kind of debt you have, then you are really missing out on the big picture. And so, like the scale of this hidden leverage is basically gigantic. What BIS estimates is that non-US banks and non-bank financial intermediaries like NBFIs, they hold over $80 trillion in outstanding US dollar obligations via FX swaps and forwards. Like this figure exceeds the combined global stock of US Treasury bills, repos, and commercial papers. Like that's how big it is. And it also represents a massive maturity mismatch, if you to say like express it that way, because institutions often use a short-term swaps, like they roll every 1 to 3 months to fund long-term assets. So this creates this perpetual need to keep roll the debt over again and again. And like when you have to move that massive amount of money on a regular 1 to 3 month cycle, what happens when liquidity soaks up? Like for example, the fragility of this synthetic dollar system is like becomes very very obvious in periods of stress. like because obviously the debt is short term and relies on willingness of counterparties, which are mostly US banks, to lend dollars, and any contraction, like any changes in risk appetites because of some market issues, will cause and does cause the swap market to seize up. So for example, it happened back into 2008 with the financial crisis. The FX swap market completely froze. It forced the Feds to institute basically an unprecedented swap lines with foreign central banks to prevent a global wave of default. A very similar thing happened in the COVID period of March of 2020, which essentially triggered a dash for cash. The basis blew out. Everyone's printed at the same dollars at once to meet margin calls and roll obligations, which again threatened the stability of non-US banking systems. So any FX on-chain solution that ignores this $8 trillion funding layer, which is more like now $100+ trillion of funding layer, is irrelevant to the stability of the global financial system. Because the real game is building infrastructure that market makes this debt feasible, ensures that it can be rolled and settled efficiently under stress. So that's pretty much where we are. Since you asked a question about the CLS and the Herstatt risk thing, let me go a bit deeper into it. Like the funding risk involves the ability to find a counterparty to roll debt, and the settlement risk involves the mechanical failure of the exchanges itself. So, for example, like the reason we call it Herstatt risk is because, like in 1974, in Germany, there was this bank like Bankhaus Herstatt that fell, which they basically took Deutsche Marks from counterparties, but but closed for some reason. I exactly don't know why, but they closed doors before delivering the corresponding US dollars. So basically, people lost money without getting the currency swaps out. So this is the risk that the CLS system tries to prevent. What they do is basically CLS acts as a specialized financial market that provides payment versus payment settlement. So the mechanism works like this. Like say CLS settles trade simultaneously on its own books. It links to the RTGS system and central banks. Like you have got Fedwire for USD, Target 2 for Euro, etc. And so a trade is only settled when both sides fund their obligations. Like otherwise, neither side is paid, preserving, and it preserves the principle, yeah, protects the principle from any unprecedented or unforeseen loss. So think of it like some sort of an escrow system. Both parties have to pay out, or both parties have to meet some sort of an obligation. Once it does, then the neutral third party does as the contract says it needs to do, and it's obviously an incredibly efficient system. Because CLS also provides multilateral netting. They compress trillions of dollars of gross obligations into net funding requirements, which in most cases come down to merely a few $billion. So this liquidity efficiency is obviously a vital requirement for dealers and banks, right? But as you mentioned, like CLS is not available to everyone. It currently only settles about 18 countries, like USD. You have got Euro, Japanese yen, the British dollar, the British pound, Australian dollars, etc., etc. So this is what leaves out $2.2 trillion in FX turnover every single day, because those currencies simply fall outside of the CLS umbrella. So this volume settles gross or via non-PVB bilateral networks. So meaning one party pays as basically what you would expect without the CLS system. So one party has to pay and essentially hope that the other party also reciprocates whenever they're available. And this is actually where also time zones and business hours also make a lot of issues, because like if you are transacting between two banks in two different parts of the world, then you can transact and then wait for a good few hours, or if it's a weekend, then maybe more than 24 to 48 hours you have to wait before the other party reciprocates. So that also creates a liquidity mismatch that you have to address, and you have to take into account when you are dealing in billions of dollars on a daily basis. So that's what the primary issue in the emerging market is as well. Like for example, the Chinese renminbi is now the fifth most traded currency globally, but it is not CLS eligible. So is like the Brazilian real or the Taiwanese dollar. They also trade significant volumes without CLS protections. And onboarding a currency to CLS requires basically a few things. Like it has to have the explicit support of the domestic central banks. You have to have have like significant overlaps with RTGS operating hours, and you also need a lot of like legal and financial certainties. So it's just quite tricky for one currency to get accepted in the in the CLS system. So for stablecoin to meaningfully impact the FX space, the FX market as a whole, we have to re-engineer the FX stack using blockchain and stablecoins and
Mm.
or every other relevant technology to solve the specific problem of hidden debt, settlement risk, and capital inefficiency. So this is the architecture that you have to create, and there are like three primary pillars. One is you have to have like quite complicated and technically robust funding contracts. Like you think of them as like a smart contract ISDAs. So ISDA is the common standard that is used across the industry. Like it effectively translates like legal stuff of a swap, like the details, notional, tenor, payment frequency, etc.,
Mm.
into a digital format that all parties agree on. So you need to convert this into smart legal contract essentially. Like you have to encode ISDA CTM into a smart contract. Institutions can automate the life cycle of the $80 trillion debt. If you do that, like that means automated margining, closeout logic, explicit parameters, etc. That's problem number one. And then you have to address the wholesale settlement assets. Like a token, you have to work on tokenized deposits. Like for example, banks like JP Morgan and consortia like Partier are tokenizing commercial bank deposits. So like these tokens represent a claim on the bank's balance sheet, just like a regular deposit, but they can move 24/7 on a ledger without having to depend on banking hours. Also, like these systems maintain the singleness of money, like the guarantee that one digital dollar is always exchangeable for one central bank dollar at par. And this is achieved through direct integration with central bank accounts, unlike stablecoins, which primarily relies on secondary market pegs, which you cannot allow when you are dealing in trillions of dollars. Like if you have a like 0.001% p peg, for whatever reason, like that can amount into billions of dollars on a daily basis. So that simply can not something that you can allow. And then finally you have to build the rails, like for atomic payment versus payment systems and intraday liquidity. You have to have a lot of pieces in place to have the system move extremely liquidity efficiently. For example, so like if there's a protocol called Fintia that utilizes blockchain to create market for intraday FX swaps. So instead of borrowing dollars for days, bank can swap currency for hours to meet specific liquidity windows. Like this creates a new yield curve for hourly liquidity. It also optimizes the funding stack as well. There is another platform, HQLX, that enables the tokenized transfer of collateral. So like this allows banks to satisfy margin calls instantly without physically moving securities across CSDs. That solves the velocity problem of collateral. And then you have a finality that provides basically a synthetic CBDC that serves as the risk-free settlement asset for these rails, like ensuring that on-chain settlement carriers uh, settlement carries the same finality as RTGS settlements. So there are a lot of protocols that are working both with central banks, with governments, and independently in the crypto space as well to address these specific challenges. But from where I stand, I see that we are not even close to properly onboard a few billion dollars from the FX swap, let alone like trillions of dollars. And completely replace or re-engineer the FX market in a way that it goes completely on chain in the next 2 3 years. I think that's just like like poor understanding of how FX work. You cannot think of it like that. This is where what actually we discussed in the last episode on the unsecured lending. We are in a place where we still don't have the mechanisms to like recover debt when a party inevitably defaults, but there are conceivable ways where protocols are like finding out ways to address that problem. uh, but like that's like step 5 out of like 10 steps that you need to take. But in the FX market we are barely at step 2. We don't really even understand what the problems are going to be once we have
Right.
the infrastructures that I'm talking about in place. So I think this is a like a really solid problem to address with a time window of 10 years maybe. Because the reason I'm saying 10 years is because it's not just like you can just build the technology or you can just build the platform. That's not it. You have to bring all of the major banks in the world. You have to bring all of the central banks. You have to go to the go to the governments and basically finance ministries and basically have long and detailed conversation with bureaucrats to understand how exactly you can bring even a like, I don't know, a couple of percentage of the FX market on chain, because
Right.
this is a an extremely complicated stack that needs to be addressed with a certain level of expertise that I think there are people that are currently working on it, but it's just going to take an enormous amount of time and effort. But yeah, at the end of the day, I believe that this is the market that if like even if it takes 10 years, it will be well worth it. Like if stablecoins gets the FX market, then the concept of stablecoin becomes ubiquitous. Then there is no more uh, you don't need to argue anymore that stablecoin is the superior asset, or stablecoin uses the superior rates, because it would have proven that it is what we claim it to be, because we are settling trillions of dollars every single day, which is not the case right now. But
Right.
again, we are extremely bullish that that's going to happen within whatever time frame that is realistic.